Join the Ungovernables. No filters, no apologies. This season, we're cracking open Uniswap governance. Welcome to a new episode of the Ungovernable Podcast.
Hey. Welcome everyone to a new episode of the Perfect timing for a cutout. That's great. Love it. I don't know where I lost everybody, but Kassandra's with us today, founder and CTO of Arrakis Finance and active delegate of the Uniswap DAO, cryptographer, software engineer, founder, always learning, previously an engineer at Gelato, researcher of multi-party computation and zero-knowledge proofs and other emerging cryptographic tech. We are Joe and Austin of Alpha Growth, your premier DeFi ops and growth firm. Kassandra, thank you for joining us. What else should we know about you?
Hey, thanks for having me. Best intro I think I've ever gotten. Very thorough. I don't know where you found all that. Maybe I sent you a blurb. I don't know, but anyway,
AI.
that was great. Oh, nice. AI knows. So yeah, no, that's me. Nothing else to report. That's perfect intro.
What about outside of the realm of the really exciting, riveting cryptographic technology?
Yeah, well, I've certainly got really nerd sniped by that. Maybe an interesting factoid is before I went down this crypto rabbit hole, I was actually a totally different domain, theater director. So very, very large pivot to get into computers, software, crypto. It's very mathy. So yeah, got a wide background, I guess.
Truly. And how'd you make that jump? That's a tough one.
Yes, super weird one. Everyone always asks. It's pretty funny. I was working on some sort of experimental theater that was actually dancers. They were computing something, like a really small logic gate based computer. I didn't know much about computers at the time, but I thought it was cool that the dancers knew, but they would either be a zero or a one, a little different. And then I said, oh, okay, I'm kind of like a technical person and this is really interesting theater work. Maybe I should learn more about how computers work so I can deepen this. And then the moment I wrote my first line of Python, I don't know, I was hooked and I just never looked back. So I'm on this very long tangent into computers because of that.
That is pretty impressive that you didn't have the Bill Gates moment where you were, first thing when you were in 5th grade or 8th grade or whenever that was, where he was like, oh, going to the computer lab and learning about this really young. That's pretty wild that you got drawn to computers not that long ago. And then now you're deep into the zeitgeist of cryptographic computing. That's so nuts.
Yeah. I'm just I would say I always was a very research oriented person. So always like to just go super deep on niche topics. And so, yeah, this was the new one. And I mean, yeah, I was really, I guess maybe to bring it towards crypto, I was really taken by how everything happens in the open. So I was starting to learn about Bitcoin and made a little tool to encode transactions myself by hand and just thought it was so neat that I was interacting with this system that nobody controlled and nobody knows who started it. And you could go so deep as some random person in your underwear in the basement with this this special new public thing. So yeah, I never looked back from there.
Would you say that right now is the easiest time in the history of humans to become an expert in a really niche thing very quickly?
Yeah, for sure. I think for sure. Of course, yeah, it's now there's so many, now the question is what to focus on is the most important thing actually. Because once you know what you want to focus on, yeah, there are so many things that can help you, AI, etc., ways to easily be self-motivated and go deep. But I still think nothing compares to the world of computers. I was like a junkie with computers at the beginning, where the fact that it was something where if you ran into an error or you got stuck, you could just go on Stack Overflow, just take whatever you saw and Google it and just brute force yourself into going deeper. I feel there are a lot of other things. It's still knowledge is siloed a bit and you have to know the right people or something to go deeper. But with computers, it was always if you have the desire, there's infinite things to read in public forums and ways to tech up by yourself. So yeah, I still think computer science is special in this regard.
Out of all the different categories that you've researched and rabbit holes that you've gone down, what to this day has still blown your mind repeatedly?
Yeah, that's a great question. I mean, there's this quote from Hal Finney in the Bitcoin Talk forums where he says like, I don't want to exactly, I'm probably going to misquote it, but something like, I've always been taken by the mystery and the paradox of cryptography. So like, I don't know, something about going all the way deep into the math of how these cryptographic primitives work and then building a POC and then actually seeing, that the zero knowledge proof checks out or the signature checks out was always like some crazy high for me. So yeah, cryptography is really cool. I don't know why, but I just something about the fact that we can actually hide things with mathematical precision and that this is like a new thing and only emerged in the public in like the 1970s. I find really, really fascinating. But yeah, I'm also through this, I'm also like deeply nerds out by other things too. I don't know, like philosophy. There are some niche philosophers that I just can't stop. I can't even believe I'm saying it now. For instance, can't stop talking about. So yeah, I'm like an uber fan of Michel Foucault, for instance. Really random thing. So anyway, I don't know.
Okay, wait. I want to click back on the zero knowledge stuff, because when I first heard about zero knowledge, it was fully homomorphic encryption via Zomo? No, Zama. You remember the company Zama?
Yeah. There's this like they're like in some sort of patent war. This thing.
Yes, yeah. So I heard about them like 3 years ago. This whole idea of zero knowledge proofs was introduced to the world, and especially with the DeFi use case. And then you have things like ZK, EVM, all these different chains that have come out. And do you think that it's here to stay? Do you think it's going to come back with a vengeance? Because it doesn't really seem to be sticking. And then, correct me if I'm wrong.
Oh yeah. I do think you're wrong. I mean, I think the people who are really deeply invested in zero knowledge proof, like at the research and math level, which is all super new stuff. I think people sometimes, again, like even just basic asymmetric cryptography, like digital signatures based on elliptic curves that, Bitcoin is absolutely based on, and Ethereum too, are only as old as 1970 something. And zero knowledge proofs are like really, really new, at least ones that are actually useful and at scale. And like people who are into the research side of that, I think are very convinced that maybe even more than blockchain itself, zero knowledge proofs are here to stay and are going to transform the world and transform the way we like collaboratively trust and do things in the world and with computers. For instance, imagine going across a border and just, getting a green check mark without having to show your name or go in or have them ask to see your phone or whatever they do in order to vet that you're actually, not on some sanctions list, right? Now they can do that, just get a green check and they don't know anything else, but they're absolutely certain that you're not on that list. And this can be applied in so many different places, in my opinion, and could really transform the social fabric.
That was absolutely the same narrative that I subscribed to when I first heard about it, and I still do subscribe to the use case a lot, pretty far outside, but more so with what I was bringing up was the DeFi use case, because it doesn't really seem like any of that has stuck.
Yeah, I think that's interesting. I think with DeFi, so yeah, also it's really important that in the context of blockchains, when we say ZK, it's actually like two parts, right? There's just the succinctness. There's the part that's just about compressing computation and then being able to verify that it was done correctly, so that it's like you can do a very fast computation instead of doing the really long one. And then there's the ZK that actually hides the inputs, and which is actually about privacy, which is like learning something without revealing some of these inputs and learning something in zero knowledge. So a lot of times when we say ZK, it's actually not ZK. It's like we say ZK snark, so we're really only using the snark part. I think for DeFi, actually the privacy part is really important. And I have a feeling eventually, I think privacy has taken a long time in crypto to grow, certainly like in the Ethereum space. But I do think maybe then you'll get this unlock where, like, if you have these actually functioning dark pools, if you have like new institutional actors coming online on chain because of the fact that they can actually keep what they're doing private, then you might see this proliferation of ZK use in DeFi, but like yeah, in terms of getting the succinctness, I mean, you know, you hear about it, I think lightly. Yeah, maybe it's outside of my exact knowledge, but it's true that maybe it's not being used too directly in DeFi things just yet. That would be maybe my guess, is when we start having like the real ZK, like with privacy as well, maybe there'll be some unlocks. But basically on the app layer and on the DeFi layer, like, yeah, users, you need to work backwards from what the users actually want and what they want to do. And until we have that sort of unlock that actually helps someone achieve something we couldn't before with apps, I don't think just because it sounds really cool or like it's a really interesting math problem, you're going to get a lot of traction. And maybe this is kind of where we're at in the DeFi ZK space. I don't know.
It might be a little too late because we just talked about this for 5 minutes, but will you explain zero knowledge to someone who has never heard of it?
Yeah, I can try. So there are some great, I can say also there are great tools like on the internet. I think the Zcash founder has like a really good like really approachable examples that make you understand zero knowledge in like a simple way, a non-technical way. I think zero knowledge for privacy, I'll try to give a thought experiment. Maybe it's like, let's say me and you, we play this game where I take a coin and I put it behind my back, and I put it in one of my right hand or my left hand. And then you pick if it's in my right hand or my left hand. And what you tell me is that you know a tell of mine. I have some special physical tell. So you know whether it's in my left or my right hand, but you don't want to reveal the tell that you know to me. But you want to prove to me that you do know this tell. And so we can play a very simple iterative game where I can just put a coin behind my back, right or left, and then you pick left, and oh, it's actually my left. And we do that 10, 100, 1,000 times in a row. And if 1,000 times you're right, after a while, you'll sort of have probabilistically convinced me that for sure you know my tell without revealing to me what the tell is. So this is sort of like the maybe a little bit of the intuition of what a zero knowledge proof is all about. And original zero knowledge proofs were actually interactive like that. You'd have to play something over and over in order to convince me. And then there are just some cool math tricks to basically make it so we can do this in one round instead of having to play an iterative game over and over.
So what do you think the big use cases are going to be for zero knowledge proofs?
I love this because I just have to say, this isn't directly my subject, so I'm going for it. But yeah, I think there are tons. Today, there's this huge unlock, right? I mean, ZK rollups, and like there are some things that are being used in production today pretty meaningfully, like rollups with applications on them. And so what's really cool is you can also just get this succinctness property as well, which is being used a lot all over blockchain to just speed things up and deal with like some of the bottlenecks that blockchains have. But with the actual privacy zero knowledge proofs, I think, like I said, I think there will be private DeFi, private financial applications on blockchains that will really explode, where I'm very excited for things like the launch of Aztec, to show a random thing that I have no affiliation to, but I think is really cool. But then I think outside crypto, there's also a lot. Yeah, like I said, I would think about ways where we're so used to, in order to verify things, in order to prove that we are really authenticated, that we're really allowed to do something, that to prove that you have enough money or cash flow to rent an apartment, to prove that you're a member of a certain set. All of these things we're like totally used to, in order to do them, just giving away a ton of information and just saying, I trust that you won't like abuse this extra information I'm giving you in order to do this. So I think all of these things, if those kinds of things become way more scalable, like maybe you can just like rent an apartment for a year and get approved for that just with an app, like in a way that doesn't involve any third parties and is just really seamless and allows for like new kinds of experiences. that'll be powered by this kind of technology, in my opinion. And so, yeah, it's hard to even say, because I think it's really radically transformative, and we're like stuck almost, normal people, in this mental model of like the only way to prove stuff would be to actually reveal information.
See it.
Yeah, but like, yeah, maybe this gives some color. I
No, I love it. And then I feel like there's huge unlocks too for different hacks where data gets passed around, like social security numbers, for example. Most social security numbers are on the dark web, and like to fight off against identity theft, it becomes really difficult for different banks or different financial institutions. But I know we could probably do a deep dive on that for like a whole hour in itself. So I'll hit on something that you are a specialist in, and would love to maybe hear a little bit from you. What is Arrakis? And maybe simply kind of explain like an overview for what Arrakis does.
Yeah, totally. So Arrakis is a liquidity layer, in my opinion, and we help all kinds of token holders. Let's say, especially, we look at like token issuers and DAOs are sort of the tighter set of like the main customer, but really anyone with token inventory who wants to supply liquidity to markets on decentralized exchanges. We help them do this in an efficient way, in a way that they can really, in an automated way, so they can like express their liquidity providing preferences on chain in a more fine-grained way. So it's really about the LP side of decentralized exchanges, which has gotten more and more complex over time, allowing would-be liquidity providers to harness that complexity and to provide liquidity to markets on chain in the kind of best and most optimal way possible for their goals. So at the end of the day, we're really working with especially people like token issuers and DAOs that have a token, to help them figure out how to deploy this liquidity on and across chain, so that swappers can easily swap their token, and that this liquidity is accessible across many venues, and traders have a good experience. So it's like all about the LP side of decentralized exchanges.
Okay. And how would you like differ compared to other liquidity solutions?
Yeah, I think we started similar to a lot of others. So another thing, like in the history of this, I feel like this category somewhat emerged as DEXs complexified, and one of the big jumps was the move from in Uniswap, when they unveiled Uniswap V4 and the idea of concentrated liquidity. Providing liquidity to a decentralized exchange now became much more sophisticated. You had the ability to set specific ranges, to set much more fine-grained preferences. And so we weren't the only ones who, as a response to this, said, okay, providing liquidity to DEXs was always awesome because anyone could do it. We want to preserve that, but now it's getting more complex. And so maybe there's this room for this sort of layer in between the unsophisticated LP and the DEX, who can help that unsophisticated LP be more optimized. I think where we really differ is we eventually found our niche specifically in these like private offerings for the liquidity provider who is somehow deeply incentivized for that specific token market to make sure the liquidity is good. So rather than focusing on like retail LPs who might want to try to farm maximally the most incentives, or just earn a yield through trading fees on like blue chip pairs, we're really focused on young tokens that need to structure the liquidity, and working with like the token issuer or as close to that party as possible to help them figure out the like base liquidity for their new token market. So we specialize in things like token generation events, how to deal with DEX liquidity at like the moment the token starts trading, as well as working specifically with the DAO token issuer, or a project that has launched a token, to figure out how to structure their market. So I think a number of other similar liquidity solutions, I think, are more focused on like specifically yield capture for like the retail participant. We're much more focused on like the setting up the initial market structure for young tokens.
Yeah, and that makes a lot of sense. Do you feel like because I feel like these services, especially, with Uniswap, for example, V2 was super easy, right? Put two tokens together, you're able to understand your LP. There is some impermanent loss, but it's quite simple. V3 became a little bit more complex, and then I feel like now you're starting to add hooks to it, which can change the game in an infinite number of directions. With that, do you feel like liquidity provisioning starts to become an institutional game, right, and moving away from retail? And if so, why?
I do think so. I mean, I think the beauty of I'm a real believer in automated market makers and like truly decentralized exchanges. I think what they enable is more variety. So I think you'll always have, at least on the fringes,
Mhm.
retail actors and retail money piped into these decentralized exchanges. And this is a benefit. This is what's so cool and like disrupts the market structure of like just the way things work in TradFi. But I do think that now there will be a lot more competition with like much more sophisticated financial entities and like sophisticated actors and traditional financial institutions who will potentially dominate the LP side. And I think this isn't necessary. This could also be okay. This is not necessarily like a horrible thing. This should help. I think most retail participants are more interested in being like on the taking side and being a trader, and this should help make those markets vastly more efficient. As you said, the reason why it's sort of, you already said it, right? The complexity is just massive. And even we saw the leap from UniV2 to UniV3 was a really big jump for just like your normal person who is, let's say, very DeFi literate, really interested in all this stuff, but going to try like to naively handle their liquidity strategy and changing their ranges. And like all of a sudden, I think people really realized this is very complex. We realized it as well, as like we were there from day one on V3 and we were learning as we go. And we I think in the very first days before V3 even launched, like I thought it'd be easy. Like, oh, we're all gonna, within a few months, someone's gonna figure out like the perfect kind of range rebalancing solution, and we'll just do that, and be more about like who will have like the best automation and optimization of this stuff. Turns out it's a super complicated open problem that I'm sure people who knew more about market making than I did when I was just starting there already could have identified. But yeah, we saw just like tons of friction just in this jump in terms of usability on the LP side. And yeah, like also friction with now this liquidity wasn't as composable. You used to get back a fungible token, now you get back a non-fungible token, and so it wasn't as composable in all of DeFi. If you wanted to incentivize liquidity on a certain pair, this was very complicated for people at the beginning. So we really saw how much friction was introduced just from moving V2 to V3. And I think the leap between V2 to V3 and then V3 to V4 is actually, V3 to V4 is even much greater, because with V4 and hooks, you literally have an infinite design space for people to design sort of whatever decks they would like to on top of the Uniswap V3 primitives, or even kind of fork them out completely and just use the singleton for like how you handle token balances, but do pretty much whatever you want in terms of market making on top of the Unit V4 decks. So I think that now this complexity, like if it was hard in terms of usability, just going and trying to set your ranges manually and check in on your positions, I think now when you're also going to choose a specific hook for a specific pair, you have to know exactly the features of that hook and then how you might adjust your strategy for those features. Maybe even you want your own set of features. You're going to be like a developer developing your own hooks in order to deploy these things. And I just think this really leans towards sort of well-capitalized, sophisticated entities figuring out how to maximally squeeze efficiency here. And again, everybody benefits, because while market makers definitely have reputation of potentially doing shady things, or like people are getting mad at them all the time, they also provided this like tool for you to swap on. Just go to Uniswap or go to your favorite front end and swap. And you can't do this without people injecting liquidity into the market. And those who are doing it, who are going to survive in the long term, have to be sophisticated managing their risk and so forth. So yeah, I think it's totally inevitable. I'll stop there.
No, there's a lot of wisdom in that. Does Arrakis have any sort of retail facing product that more of the middle market, even small whales, big sharks could be interfacing with?
We have some old ones, but right now it's really not our focus. I think we want to figure out, we kind of only want to really push that when we know it's something that is like long-term sustainable for retail. So it does crop up occasionally, and you can see we do have like currently some public vaults. If you go to our app.arrakis.finance /palm, you can see some offerings of some different public offerings for like anybody who might want to pledge some capital to a pool and earn some certain different kinds of rewards. But I would say, yeah, and over the last year, we've really pivoted our focus to razor focus on these DAOs and token issuers. And it's not like we were abandoning retail. It's just we believe that soon it might be possible with more structured products and hedge things to give them an offering that's like long-term stable for them. For now, the only things that are actually interesting to retail that like are in expectation profitable and yield bearing for you are really only when there are these third-party incentives. And the thing is, those usually only last for a certain amount of time, or those yields are only lucrative up to a certain amount of capital and for a certain amount of time. So it's sort of like we've done it before and we may do it again, but it's often been just kind of like short-term boom and bust. And I'd only be excited about really focusing on retail if we can find something that's like more long-term and sustainable.
Fair enough. What is the relationship between Arrakis and MEV? How do those two play with each other?
Yeah, so I mean, I think like one of the big topics in decentralized exchanges, and especially on the LPing side, though really on both sides of the market, is MEV, right? And MEV is this design and structural problem that's really not doesn't necessarily need to be surfaced to users in the end. It's like I believe that just by designing better apps and better primitives, MEV will be like a much smaller topic eventually. It's just that, you know, in crypto it's still so early, and so we're designing these totally new primitives like AMMs, and there are some side effects that simply couldn't be known in advance, or could only really be understood.
Would you mind breaking down MEV for the layman?
Yeah, sure. MEV, that's known as maximal extractable value now, came from minor extractable value. And it comes from the value you can extract by being the one to order transactions in a block. So all transactions in blockchains first go into a mempool, and then they end up in a block. And that block is ordered usually by one privileged entity, whoever has the right to propose that block. In Ethereum, one validator per slot. And you know a little bit in advance that, okay, that's my slot. I have total rights over ordering that block. And it turns out if people are doing financial activity, like you can see that everyone is about to, I don't know, let's say buy ETH in the next block because those are the pending transactions. Because you have total control, total rights, like feudal right over this block space as yours. You can decide how transactions go into that block. So if everyone else is buying ETH, maybe you can insert your own transaction to buy ETH ahead of all of them. And maybe you can even do more sophisticated things, which aren't just like betting on a certain token, where you can buy ETH before everyone, allow everyone else to buy, and then sell on the way afterwards and make a profit from the price at the beginning of the block and the price at the end of the block. And this would be known as like a sandwich attack. But essentially MEV is just all around the value you can extract by ordering the way pending transactions actually end up in a block.
You explained that really well, by the way. Thanks. That was perfect. Very easy to digest, that explanation of MEV.
So cool, but then so like as you can already see, it's like only like when there's trading and so forth happening, MEV usually proliferates even more on blockchains. With AMMs, we've learned there's a lot of painful MEV. There's like this sandwich attack that I mentioned, where because prices on AMMs just like directly move with how much volume goes through the AMM, you know that some trade is going to move the price. And so if they have some slippage conditions on their trade, you can abuse these conditions to just like extract value risk-free. And the other one that really affects liquidity providers is the fact that prices on AMMs, we don't know anything. Like they're totally neutral to the real world and how prices are moving on other venues outside of the blockchain. And so because blocks on Ethereum come only every 12 to 14 seconds or so, every 12 seconds, you have this risk-free trade you can take at the top of the block by basically, if the price moves enough on other venues, you can move the price on the AMM and these basically take this stale priced liquidity on the AMM at the top of the block. And this, if you're making money from this trade, now you have to be sort of sophisticated because you'd have to have money on another venue as well to sort of do the full ARB and make this profit. But if you have the sophistication, you're making risk-free money, and when you do this, or like low risk, if you make a profit when you do this, where is that profit coming from? It's not coming out of nowhere, right? It's coming from someone's pockets. It's coming from the LP's pockets on these two markets that you're equilibrating. And so, yeah, there has been tons of ink spilled. People are still working on it and thinking about it, and tons of brilliant people figuring out solutions to this. And I think we will have great solutions to this problem.
But I'm gonna push back a little bit on that, and I'm gonna play devil's advocate and say that I think it's a little bit loaded to assume that this actually is a problem. I don't think everybody would agree that MEV is actually a problem. Well, the people profiting from it, of course, are not going to think it's a problem. And the more that you have extractable value, the more likely people are to participate in the blockchain and decentralization and push these other things forward. So there are some arguments that that MEV is not entirely a bad thing. What would you say to that?
Certainly, and there are also like less toxic forms of MEV as well. I mean, I think in this case, I think the thing that people don't like, which I think I personally can understand pretty well. Now, maybe there are some interesting arguments I haven't thought about, like in the vein you mentioned, but like on an AMM, because of this arbitrageur actor, right? We don't know the AMM only converges to the real price because of this arbitrage. It's kind of like we're paying a random third party, anyone, whoever wants to do it, to help make these AMMs function, to help them price different tokens at like sort of the right price as information in the world evolves and people go, oh no, this thing has been hacked and now everybody thinks it's worth a lot less, or I don't know, they fired the CEO, whatever it is. These things, the blockchain doesn't know about them and doesn't have a way, and this information is delivered by these arbitrageurs, which sounds cool, but if you're paying, like, the goal of a market would be to pay as little as possible to these. Like, why pay a random person? I believe it was like Max Resnick of once Ethereum fame who said, like, AMMs are kind of like a leaky bucket. So this is just value that's flowing out of the system. It's not going to the traders. It's not going to the LPs. It's just going to these random participants who are, sophisticated enough to spin up these bots. Why pass the value there, right? If you could avoid it, you would, right? I believe, like, sure, there can be value generated from these things, right? LPs take a fee on every trade, and that's great. But it's all about, like, where does the value actually flow? And today, 99% of this MEV value flows to this validator who has, or maybe not 99%, but a lot of value flows to this validator and these participants in the MEV pipeline, builders, validators, searchers. And that's not to LPs, not to swappers, so not to like the real retail participants, but to just these third parties. Yeah, sure, it's cool that they're playing, but they would play anyway. They'll play if they can make 1 penny of risk-free profit. So if we're paying them tens of millions of dollars a year on the ETH-USDC mainnet pool, maybe we could just change some of the logic in these smart contracts so we pay them less, and they would still come anyway, right? Because again, if they're making risk-free profits, even if it's like you will just want to make sure you make a really competitive environment for them so that as much value as possible flows back to like normal users, which should increase blockchain usage much more than if you get lots of value extracted to just like sophisticated participants.
So it's a little bit of like kind of a necessary evil, but you want to minimize that necessary evil if possible.
Yeah, like in market design, you often just want to create as much efficiency as you can, and as much competition among different parties to like maximize your efficiency. In my opinion, what we have with the current MEV landscape on DEXs is like a bunch of dead weight loss and kind of like a market that's designed. It's like you have a bucket that carries water and it has a hole in the bottom. Like one thing you can do is just try to patch the hole.
Yeah, plug the hole. So I guess when you're working with these different protocols and different DAOs, like when it comes to liquidity management and plugging the holes in the buckets, what do you have any like top tips you would recommend?
So yeah, that's the thing. I really feel like it's not, I'm hoping that it's not a problem that's like has to be swallowed by like the outer parties, but it's really a problem for people who are designing Uni V4 hooks or designing things like Uniswap itself. Hopefully we can kind of solve these things at that layer, because sure, there are definitely things you can do to avoid major snafus. I think in the real world, in practice, what we help DAOs with a lot in terms of MEV is like foot guns, right? Because actually more than you might imagine, there are like major mistakes that end up having huge MEV, like supplying liquidity to a new market at like completely the wrong price without noticing it, and then just exposing yourself to a massive arbitrage and like creating really weird effects in the market and losing a lot of money like instantly. These things happen all the time. So like these really basic things about understanding the adversarial environment and like having proper checks and so forth in place to be doing like relatively sane things is something that I think concretely we end up helping a ton with. On top of that, yeah, there's like, that's the problem is from the LP side with this like this kind of arbitrage that I'm talking about, there's not much that you can really do today because it's literally sort of in this market structure that you have to deal with this. I think still there are there are like secondary things you can do, but the core problem can actually be fixed by having cooler hooks, cooler functionalities in blockchains themselves. Maybe things like what's being done on Unichain and Optimism with flash blocks, plus using MEV taxes inside of a Uniswap V4 hook would just kind of magically make a lot of these problems go away. And we could click into what exactly with it. I don't know.
What's an MEV tax? Because I haven't heard of that before.
Yeah, this is a really cool idea, and I love it because it's so simple. From Dan Robinson from Uniswap was, I believe, the one first really thinking about this. The cool idea that they realized is that L2s today have like centralized sequencers, and they basically have sequencing rules that are way different than Ethereum L1. What I was talking about MEV was like in the Ethereum L1 context, where you don't know who the validator is, and a random validator selected every block, and they can do whatever they want with ordering the sequence. And what they do today is actually they broker a deal with these specialized builder actors with MEV boost, and like that's how blocks get ordered on L1. It's basically very anarchic. You can do whatever you want with your block space. But because L2s have centralized sequencers, some of them, and hopefully maybe we'll see L2s with different designs, but for now the big ones do, you can leverage the fact that this sequencer can now have specific rules about how they sequence blocks that they'll just commit to. Now, you are trusting the sequencer to do this, but you already trust centralized sequencers on L2s anyway to, for instance, not censor you and like include your transactions. And so if these centralized sequencers commit to saying, hey, we will definitively order our blocks based on priority fee, which is like how L1 validators used to do it vanilla.
Yeah.
Like if you just use the normal vanilla code, you would do this. But the thing is, you can actually run this sidecar MEV boost and do whatever you want and sequence things actually not based on this priority fee ordering. But on the L2, this sequencer could commit, I will absolutely use. So if you put a higher priority fee than someone else, you will go ahead of them in that block. And then the cool idea, if you make this commitment, which Optimism and Unichain and all the Optimism chains, I think, or most of them are taking, the OP stack chains, you now have this amazing property, which is inside a smart contract. You can actually check the priority fee. So like there's an opcode you can use to check the priority fee. And Dan Robinson's extremely simple idea was, what if you take whatever priority fee the user is using to express, hey, I really want to get into this block because I really want to trade before someone else, or I really want to be the first trade in this liquidity pool so I can arbit. Well, now you can multiply the fee that the amount they're willing to pay in priority fees by 99 and add that as a fee that they must pay to the liquidity providers in order to take the trade. So whatever you put as your priority fee is also going to affect the fee on your swap. That's the idea. So if you put a high priority fee, your swap fee goes up, which means now you don't want to put to, like, if you start putting a higher priority fee, and now what I said is it's 99 times larger than whatever you added as priority fee, is what you will now pay to the LPs. So this means that every time you add 1 unit of priority fee, you add 99 units of more fee to the LPs, which means 99% of all this MEV should get recaptured by the LPs. So the issue is, like, this MEV isn't that bad. It's just like it's flowing to the wrong parties. It's what a lot of people say. And now with this simple mechanism, if you have sequencers that work like this, you can be pretty sure that the MEV will flow back to the application. And what's really cool about this MEV tax idea is it works for like it's super generalistic. It could work for liquidations on lending markets. Any DeFi primitive could now slap this simple thing on the top of the function, their smart contract functions that checks the priority fee and says, if you're paying priority fees, you also owe a fee to the application. And the application can thus claw back the MEV they generate. So yeah, that's the idea of MEV taxes. Yeah.
It sounds like it'll plug some of the holes in the bucket.
That is the goal, right? That is their idea. And it's actually pretty interesting that it hasn't really been, I think it's still in super early days. So we're not even really seeing that much of this being used yet in production, but I think we definitely will. I think it's a very exciting line of research.
So I guess maybe one more question about kind of AMMs and DEXs. How do you see the competitive landscape growing with DEXs, and what do you think the focus is going to be? I know with Uniswap, it's kind of been more infrastructure, but how do you see the DEX landscape growing?
Yeah, it's so interesting. It's really hard to know. It's a really exciting time because I'm a believer that UniV4 is a really interesting and strong design for the future, like nice principles. I've always been drawn to Uniswap because I feel like they come from a market design first approach over everything else, just like what's the right market structure, and deeply thinking about that rather than thinking more from kind of a business angle of like, how do we capture more users? Or, of course, they want to do that as well, but they lead with this really kind of research first, like what's the right design, rather than like focusing a lot on the kinds of incentives they can use with their token and so forth. So I think that's really cool. And I think UniV4 has a really interesting design and a shot to be potentially like a major hub, not only for spot market swaps like a DEX, but even other kinds of DeFi primitives, which I could see kind of forcing themselves into UniV4 hooks just to access these network effects of this singleton, right? Where all the tokens are in one single UniV4 smart contract. And this means that tokens don't have to hop and you don't pay like extra gas fees for all these transfers. There's just a transfer at the end of the big operation you want to do. And so like if you get a lot of network effects in UniV4, you could see this crazy compounding where every other DeFi primitive sort of has an incentive to actually build it somehow on top of UniV4 or connected to UniV4 in order to access some of the liquidity network effects and like some of the gas optimization you get out of the singleton. So like, yeah, I'm really excited about this architecture, but at the same time, I think in the real world, right, things are very path dependent. And you have to also win the market share. And it's totally not clear that this is just going to happen by default, right? Just because Uniswap is this big name. So I think you see a lot of competition as well. A lot of people innovating sort of in other ways. It kind of reminds me of like Ethereum versus Alt L1s as well, where people, the sort of smaller competitors are using different approaches, maybe cutting some corners, but also finding a way to be innovative, right? And sort of question whether the big incumbent is really going to be the future thing. So I think you're seeing this today with spot markets. I feel like one thing that really has to be sorted out is interop across chains at least in the Ethereum world, EVM world. Without that, right now things are really fragmented, and so you also see things where it's really hard to judge whether something is really going to be big or whether it's just kind of playing a short-term game with you see some dexes that target a very specific chain and ecosystem and community. This can work really well, but is that really helping us like solve the big problem of figuring out how to make blockchains awesome and make our markets like better than TradFi markets? I'm not sure, but maybe. And so, yeah, there's tons of path dependence. And you see like a huge success to think projects like Aerodrome, which have taken like a very different approach than Uniswap in a lot of ways, but have absolutely found ways to kind of outcompete them in the market. So really
the Aerodrome Velodrome model is, I think, really interesting because they're taking like a short-term incentive, a short-term model and stretching it out into the long term somehow. They've managed to really thread that needle, and it's the most sustainable Ponzi that I've definitely ever seen. Don't get me. I mean, it's a great team. We love working with those guys, but it's pretty wild. Like that was a pretty revolutionary way to. But when you really peel back the layers, it's like, that's interesting. You're playing short-term games, but somehow it does work as long as everybody continues to play the short-term games into the future.
Yeah, exactly. I mean, to me, and I totally agree. I mean, I don't want to be like making any claims about other people and so forth, but I do think like when you focus on, and there is really cool innovation since Curve onwards, right? Of which I feel like even Aerodrome is like a bit somehow related to, like, they use the VE
Sure.
model, maybe more like Solidly is more than what they were directly based on, but still that comes from this Curve world. And I feel like these working on the incentive layer isn't meaningless. It's really cool. And there are ways to superpower your product and sort of get traction by focusing on actually the kind of incentive part of, we have this token and we can distribute it in certain ways to incentivize capturing more LP and maybe optimize the usage. And like this has proven to be very interesting. I just think, as you say, one issue is the sustainability in the total long term. And nobody really knows because it can be really hard. It can, as you said, maybe it's working well, but is it only working well because we're not in sort of the decline part? And if the decline happens, does it unwind like a Ponzi? I feel like you never know what's a Ponzi until the unwinding happens, right? And maybe in 50 years we're going to say, the US dollar was a Ponzi. You hear it all the time, right? But nobody will really feel that. Mom and pop, your parents won't feel that until they actually feel the pain of the unwinding and go, oh crap, I thought this was real, but now you guys are, now a few insiders are exiting and we're left with nothing, so
I definitely, I take back my comment. VE tokenomics is not the most sustainable Ponzi. The United States dollar is the most sustainable Ponzi that has ever been released. Yes, I stand by that.
So we'll see. But I think the issue is if you get too caught up with the incentives part, it can really, really work. But like you're kind of putting a Band-Aid on top of these other structural issues that you can just fix of like the core market design itself, like how the swapping works. Sometimes it feels like you're putting a hat on something that like to sort of hide that it's an ugly face or something. I don't know. I don't know this metaphor.
And we've definitely seen a lot of that all over the place, different chains, different protocols. That's the oldest trick in the DeFi book for sure, even though there's not that many pages in that book. Let's double click into the incentives though, because that is a topic that we've all decided is going to be the main growth lever that the foundation uses to grow some of these big projects, right? The V4 hooks and Unichain, and they've got a massive incentive budget to really kickstart that party. And the key there is that is going to be used to kickstart the party, right? So we've got kegs, we've got pizza at the party. It's great. People show up, people drink the beer, people eat the pizza. But what's going to keep everybody in their bags committed to V4 and committed to Unichain?
It's a great question. I mean, I think the first step that I really like about the approach that Uniswap is taking, and like with their partnership with like Gauntlet and so forth, I remember 2 years ago at ETC, I saw one of the Gauntlet people describing how they were working with Uniswap to think about how to do liquidity mining incentives in a more principled way. So like, I feel like the first step is acknowledging that it's not just about making those tokens go around and kind of selling the idea of we're all going to start earning and locking and so forth, and thinking more about like, okay, the game is you want to put incentives to bootstrap, and then you eventually want to remove the incentives and see if you actually bootstrap some activity that is now sustainable. And so like the fact that they were doing that experiment in that way was already a great signal, because it seems like it's focusing not on incentives, right? Like these other things are literally, they're structured to be like incentives forever, right? Curve and so forth. I mean, maybe Curve ends, I don't know, but I feel like Aerodrome, I think, is like going to be always incentivizing. Like it's embedded inside the structure of the market. So this is like a very different idea. It's like, okay, we put incentives truly as just a bootstrapping mechanism, which was always like kind of the original idea of this token, using a new token that you issue to bring liquidity to your DeFi idea, was really always supposed to be this like first phase, acquisition phase. But a lot of times, people kind of psyops themselves into saying like, let's never turn this off. And basically afraid to see what happens if you start reducing those incentives. Can you actually bootstrap something that now, like the idea would be in a DEX that you incentivize LPs so that they come in the first place, and then that actually stimulates volume, because you have a chicken and egg problem. There's no volume if there's no liquidity yet, but maybe once there's a good enough liquidity, all of a sudden you really stimulate volume that's willing to pay fees to these LPs, and then even if you remove the rewards now, the LPs are actually making a profit just from the fees. This would be like, as long as you're pointed in that direction, I don't know how easy that's going to be, but like that seems like the right experiment to run. And so I'm pretty encouraged by that. I think it's still really hard, right, for a DAO to coordinate exactly how to tune all these variables. And, it's $100 million budget or something that you try to allocate in the right way through a bunch of forum posts. Like, I mean, there's still definitely going to be it's not going to go perfectly. But I think having that approach where you're actually trying to stimulate something that will become sustainable without incentives, and sticking to that, and then really measuring where it's working and where it's not, I think that's a nice start.
Do you think there's any room for leveraging like automated liquidity managers to improve incentive programs?
I think so. I mean, it's just really interesting. It all depends. There's a lot of like minutia how you do it. Like I think they're going to use like the Merkle way of doing things, which is nice because it's great, because it makes it so that both anybody who wants to participate and like liquidity managers who on behalf of retail optimize the positions can all try to gain from these incentives, like play the game of these incentives and provide liquidity. It's interesting about whether we've thought a lot about the different ways that this can be done and what it creates. I think what's interesting is, once you put incentives, you create a game that's just a pure financial game to just maximize your share of these incentives. And that's not always the same goal as making this liquidity really sustainable. So we've seen in the past things like, liquidity providers that put super concentrated liquidity to get tons of the incentives, but over a very short time frame. And it's like, does this actually help bootstrap that market or not really? Because sure, I mean, it is really good liquidity for those moments, but it's sort of very erratic. So it's not like over the long term, they're really helping the sustainable liquidity there. They're kind of being more mercenary and just trying to be like more effective at farming these rewards than others. So like, yeah, the reason I mentioned that is because I mean, liquidity managers sometimes, like, maybe because of like social relations or other things like that, they can be more principled about how they do this thing. But on the other hand, they could also be the ones to like figure out how to super optimize the like extraction of these rewards in a way that's maybe just like great for you as a yield earner, but not necessarily as great for the market structure. And those automated managers can do that too. And if they do, maybe that could create some weird effects as well. So could help, but I think really it's like a liquidity manager is basically just a conglomerated liquidity provider, right? So it's just another actor. And I think they have the same incentives as normal LPs.
Is Arrakis planning on directly leveraging V4?
For sure, V4. We're about to roll out a V4 hook. Most of the liquidity, this like liquidity with DAOs and token issuers and institutional liquidity that we have, that's almost all of it's in V3, will migrate to UniV4 pretty soon. And then use our hook, which allows us to do like dynamic fee setting. So yeah, we're definitely going to use V4. In terms of getting these incentives, that's an interesting question too, is like what pairs will it be on? If it's mostly like blue chip pairs, potentially we will do something. But as I said, this isn't our main priority because it's always this thing where, we'll do that for the 3 months while those are really lucrative, but you kind of have to keep chasing the different pairs and things. And we don't see that as our main forte, as like being the ones eyeing these different third-party rewards. And so we'll see. Depends sort of how lucrative they are, what pairs do we see an offering that's good for our users. But maybe the other thing is maybe there will be incentives on actually the pairs that we use with some of these token issuers, in which case for sure we'd be very excited about these incentives.
What is something that you wish more people challenged about DeFi?
Yeah, so I mean, I'm like a real like crunchy person, I would say, or like I'm really principled. Like I got into crypto really from the idealistic vision of it, just like I said, like some guy in my basement completely nerd sniped, he's theater director, nerd sniped by the Bitcoin white paper, saying like, I'm gonna learn every single thing about this. And so yeah, to me it's really about way bigger than these companies, their governance tokens. We're trying to build something totally new here that we don't even know what it is, that hopefully can stand the test of time, like things haven't before, like more than governments have before, kind of thing. And I think in DeFi, it was such an amazing explosion in the first DeFi summer that everybody kind of maybe too easily sort of settled that like this is how DeFi works. There are these VC-backed companies and they launch tokens and create these protocols. And because they create these protocols and people use them, their tokens go up. And I think it's not that that doesn't exist or can't be cool, but I think we sort of just were like, oh, okay, there's this new Silicon Valley of DeFi projects that totally make sense. And it's like, this is completely nascent. That may not be how development in crypto actually like stands the test of time, even in DeFi. So yeah, like the biggest questioning I will have people I would have people question is like, are these VC-backed startup style projects, of which Arrakis is among them, is that what DeFi is and what DeFi needs? Or are there other approaches as well to DeFi that are really important? And that could really work? Or like, I almost feel like sometimes you can leapfrog some of the things that these sorts of go-to-market strategies have if you have like a totally different approach. Who knows, like in my crunchy utopian world where you just build stuff as a developer and retroactive public goods funding works perfectly, and if everybody uses it, you're actually really well incentivized to just make it and give it away and not have to figure out why it has like where the business model is for you. Like I think in this major unwinding period that we're experiencing right now, right? It's a moment where we can also like chart different paths through DeFi. And yeah, I mean, that's the big challenge I would give to everybody is like, how close is crypto and DeFi to Silicon Valley, and how is it similar? Maybe in some ways, but how is it different too? There are some ways that it's very different, and maybe we are sort of skeuomorphic right now, and it won't be like that in the future. So yeah, it's my take.
That's awesome. You're a brilliant guy. We really appreciate you coming on. This was the hardest my brain has worked in a long time.
Yeah, I was talking a lot of random stuff there.
No, you're very articulate. You're very articulate, and you speak about these very complicated concepts in a way that even I can understand. So I appreciate you.
Great meeting you guys. This was really fun. Thanks for having me.
All right, guys, that's a wrap of another episode of the Ungovernable Podcast. Kassandra, thanks again. That was awesome. For our listeners, please don't forget to subscribe on Spotify, YouTube, drop in new episodes every week, and follow us on X at Grow Uniswap to stay up to date. That's another episode. See everybody next week.
This was the Ungovernable Podcast by Alpha Growth. Watch all our episodes on YouTube or Spotify or weekly live on X.